Asia needs trillions to resolve a serious infrastructure shortage that threatens to hold back some of the world's fastest growing economies. In 2015, the Asia-Pacific region accounted for over 52% of the world's infrastructure spend. At present, the public sector funds 90% of infrastructure development in the region, but it cannot fund the region's future needs on its own. There is ample private capital available in the world and in Asia to meet this demand. Global institutional investors currently manage more than $50 trillion. However, global investors have alternatives. Infrastructure projects across much of Asia do not always rank as most attractive options. There is simply too much risk and uncertainty over investment returns in the region. Infrastructure investments globally are economically beneficial, but in several cases, not financially viable. There is a role that governments and official development partners can play to help expand the pool of bankable projects. As the infrastructure financing gap in Asia rapidly grows, the question is how market players like governments, international financial institutions, and private sectors can collaborate to bridge this funding gap.
Everyone, thank you for joining us at this early hour, this event. I want to thank this very select panel for also being here to shed some light on this very important topic. The sacred function of the Asian Development Bank and other multilaterals is precisely mobilizing resources. That's why they were created. It is fitting to talk about this topic here, sacred function of the institution, and to do this we have, as we said, this very select panel. Let me start with Topi here to give us this, help us with providing the overall perspective of what's going on in the market. Bern Union is a global organization, 83 members, from 73 countries, and you represent collectively most of the business on export credit and insurance industry around the world. What implications do you see for the type of countries that are the majority of countries in Asia now, middle-income countries, right? 38 of the 40 clients of ADB are middle-income countries. What implications do you see of these global trends that we should pay attention to?
Okay, thank you, and thank you very much for the invitation to come to your meeting here in Manila. I think I've been last here 2003. That was a time when actually Philippines happened to be the largest exposure of my agency because we were financing the cellular phone networks for the local operators here. And I think coming from a country of 5 million, I was here on Valentine's Day, and when my client told that over 120 million text messages had been sent through their network, which we had financed, over our dinner only. So I think it was mind-boggling to me. Yes, but let's go to the subject. Yes, Bern Union members are, you mentioned the number of Bern Union members. We are 70 export credit agencies, so practically all the ECAs, from the biggest ones to the smaller ones. And then 4 multilateral agencies and 9 credit insurers, private companies. And if you really look where the bulk of the business comes, 90% of the business is short-term credit insurance, and 60% of that is handled by private companies, 40% by ECAs. But it's in Asia, this share is vice versa. The Asian ECAs cover well more than half of credit insurance in Asia. So in Asia, this credit insurance business is much more dominated by export credit agencies than in the rest of the world. The total volume last year of Bern Union, because this huge amount of credit insurance business amounted to 14% of the world trade. And really, I think it's even higher because much of the trade, intercompany, intergroup trade, is not insurable. So it's a high percentage, and it is growing. Also in Asia, credit insurance is growing. As trade is growing, insurance is growing with that. So we are all in the business of credit enhancement. We are unleashing private capital to fund these projects. We don't have the ECAs don't have a developmental mandate. The private companies are private businesses. They don't have a developmental mandate. Of course, our 4 multilateral members have a developmental mandate. But when you come to think about it, the amount of trade that we support has a huge developmental impact.
Thank you very much, Topi. We heard about this umbrella organization perspective. Let's dig a little bit more on the perspective of a very important actor operating globally, SACE, and well-experienced, 40 years of experience in the market, and I understand 80 billion of insured projects in 198 countries around the world. Can you talk about your business, the nature of your business in Asia? What portion of this total 80 billion are dedicated to Asia, and what potential do you see for demand going forward?
Okay, thank you very much, Martin. Yes, we have a fairly sizable portfolio, $80 billion, and I would say roughly 5% only of this portfolio is currently based in Asia, which for us is clearly a challenge to do that much more in the region. And it has become for us, especially in the past 2-3 years, a major strategic focus area, including some major plans we have in our industrial plan, we call it. It's our 4-year strategic plan. And the first tangible results are already seen, and you will see more when we open a third office in the region. We are one of the few export credit agencies that also believe in having a physical local presence in order to understand better the needs, the specific requirements of the local buyers. As a result of which, over 10 years ago, we've opened an office in Hong Kong. We have an office in Mumbai, and the news for us actually in this coming month, we're opening our first office in mainland China, in Shanghai, and we will be only the second export credit agency to physically open in China, and the only European agency so far to open in this part of the world. That is a clear indication of where we are heading. I would also say that we don't always finance or support trade only in the usual suspects. Clearly, China and India represent still the major, if you want, countries for us. However, just taking for an example, last year where we in the area supported over 92 projects, I think. Many of these went to countries also such as Mongolia. We have exposure in countries such as Sri Lanka, the Maldives. Myanmar is now, still pipeline projects, but it is increasing. So we are seeing in parallel many new emerging markets come into play. Still early days. The issue for us more than any in this part of the world is the necessity to address our exporters only when it comes to the small transactions. So clearly we are very involved in the very large infrastructure projects, but above all, being Italian exporters, we're very present in the oil and gas industry, in the shipping industry, steel, and also petrochemicals. However, 70% of our business is with SMEs, and this is another trend we can see in the past 2-3 years, also in this part of the world, the arrival of many small companies. So at times, Italy is famous for certain goods. We can think of fashion, we can think of food, luxury items, but machinery and equipment for light industry or agriculture is probably the biggest area of export coming from Italy. It's less glamorous, it's less in the news, it's less evident in terms of our partners, in terms of the financing. It's not normally, highlighted by the likes of the ADB and other IFIs, but this is part of the trade that we hope to enable in terms of, as Topi mentioned earlier, cross-border country and, enhancing world trade in general includes also these type of transactions. So what we see in Asia currently is, a dual process where some countries are only starting to emerge, but we are already doing the first projects, which are always, a case of testing the waters and enhancing further new products. And then we continue clearly to support the very large, important development projects where we see a lot of co-financing now also with IFIs. I would stop here. Thank you.
We've heard from both colleagues here about the institutional perspective. Let's now hear from someone who uses these funds and mobilizes these funds. As we heard, Benji is the chief executive officer of Unilever in Philippines. Obviously a global actor, consumer good company. And can you talk about your experiences in mobilizing resources for the number of, I'm sure, projects that you have in Asia and particularly in the Philippines, and talk a bit about the implications of growing tensions around the world, very much also affecting Asia, trade wars, etc., right, for your operations here, and the overall implications that you would see as private sector for mobilizing capital towards Asia.
Thanks, Marvin. I think the first point to make really is that businesses, the private sector today, has a role to play to complement what institutions like ADB and other credit institutions do to help build economic development in the country. So we're not here to just make money, but we have a role to play to have an inclusive growth together with the country. So that's the first principle that is important for Unilever. So we have what we call globally our Unilever Sustainable Living Plan, where we have committed that we will grow while having our environmental impact and making sure we help in the livelihood of people all over the world, 2 billion people over the world. And so, therefore, it's important for us to not have money or credit use that is on the sideline, that's like charity, that's not core to our business. And what we've learned over the years is that more and more of our funding and our spending has been to the core of our business in order to help others. So what we do with them is that our end-to-end business has to be sustainable then, from smallholder farmers, of which over 1,000 of them we support, directly buying tamarind, yam, and other requirements from smallholder farmers, up to the end where we help provide credit to distributors who sell to mom-and-pop stores and groceries nationwide. We have a couple of examples that I'd like to share, perhaps, of how we use this to be able to help society. One is we have a brand called Purit, a water purifier device, sold for, let's say, $100 a unit. Now, for many of us, $100 is nothing to be able to get safe drinking water. But because the objective of that product is to be able to help sustainably the poorest of the poor, and when I say sustainably, it has to have a commercial benefit for us as well, we partner with other microfinance institutes who get this $100 product, offer this to their members, who only pay $2 to $3 a week over the course of a year to pay for this unit. In this way, there is a benefit for the microfinance institute as they earn interest out of it. There's a way for us to earn commercially out of it as well. And most importantly, the poorest of the poor, the bottom 30% of the pyramid, are able to get safe drinking water that passes US and European water standards. That's one model that is inclusive, where we're able to make use of credit that is able to benefit society, where it's a sustainable business because it's not charity. It's a business where everybody is able to make a commercial benefit out of it and help society. The other example we have is what we call Kabisig Summit, where it's where we used to train 100,000 mom-and-pop sari-sari store owners, basic cash flow, basic inventory management, how they could run their business. This has helped them grow their business by growing over 5% more than what they were used to before, and has helped us also because we were the ones selling the products to them. So I think as more and more companies follow this trend, where we believe that for us to be sustainable and winning in the market, it will have to be an inclusive model where the end-to-end system is benefiting, that helps in economic development. I think that is the future role that becomes bigger for private institutions like us to play in society. And that becomes more sustainable. And I think when you have private institutions, government, non-government, credit banks to help make this happen, it becomes a cycle that can become more sustainable.
Thank you very much. We'll come back to that, and also I'll go back to you to hear your perspective on the question that I originally posed, right, on the risks that you may see that what is happening around the world may have on mobilizing capital for private sector initiative. So just let's park this, save this, and go now to Vice President Gupta. So before these perspectives, and as I said, the central and sacred function of these multilateral banks is mobilizing resources. That's what it is. It's financing and essentially mobilizing resources. The key to the game is amplifying the multiplier effect of the resources that the institution has. The key to the game is leverage. So, Vice President, what role do you see ADB playing in mobilizing resources towards Asia? And do you see any role in using credit enhancement products, guarantees products, as our colleagues here have talked about, AB loans, using the guarantees of the bank, risk transfers, etc.? Can you give your perspective on these things?
Sure. So Marvin, as we saw in your presentation, and I think the figures are all quite on the fingertips of all of us, the gap in Asia on infrastructure all the way to 2030 is $26 trillion, which is $1.7 trillion a year. And much of it comes only from the government, 70%, 90% in some geographies, as you said. But the point is the bulk of it so far has come from the government. The point also is that governments can't sustain this kind of infrastructure spending or investment. It has to come from the private sector. Now, on the one hand, the top 100 global funds have $40 trillion sloshing around. How much comes into Asia? Maybe 100 billion at the most, in all forms, infrastructure even less. So which is 0.1 to 0.2% of just the pools of capital which are waiting to be invested. Why does it not happen? It does not happen because investors don't feel comfortable. And credit enhancement products bridge that gap, something which investors perceive as too high a risk. Credit enhancement tends to mitigate that risk, or rather transfer that risk, and therefore make it attractive for these pools of capital to come into those areas which are deficit for investment capital, but they need it badly. So what are the situations in which this can be used? One situation would be where local resources are not available. That's the case with most of Asia. But getting dollars in has two risks. One is the forex risk and the other is the political risk. So now ADB steps in to do enhancement of these investments, and therefore investors, when they come in, they would buy political risk from us. In some cases, we would also be co-lenders, therefore giving a signal that we are fine with the investment. It is commercially viable, including factoring in the forex risk. And that is one signal that we do. We have done a fair amount of credit enhancement over the last several years, about 5 billion in the last 5-6 years. And that is a very important area of business where credit enhancement works. The second is where new sectors have to be targeted. So microfinance, for example. We've done about $600 million worth of running a credit guarantee program for secondary lending through financial institutions who would otherwise not perceive this as an acceptable risk. And in the process, we've helped about 24, a little more, about 30 institutions in India and other places in Asia. And that has led to the dissemination of credit to the microfinance institutions. That is leveraging of sorts. The third would be where, with Basel III and other things coming in, lenders will typically be more and more averse to giving long-term credit. Infrastructure needs 20 years, 15 years. Mainstream banks will find that they have to allocate far too much capital for that kind of an investment. And therefore, there is a need to disintermediate and get investors directly investing in project bonds. And that is the third place where then we come in with the credit enhancement. So we have done a fair amount of this. And in Philippines, we did the TV Macpan deal, which is a classic example of how mainstream commercial banks came in with $200, $300 million because we underwrote part of it. So that's again a credit enhancement product. These are the various areas in which credit enhancement works very well. Now, we have to understand one thing about credit enhancement. It only transfers risk. It does not mitigate risk. It does not put up collateral. It does not give you cash. And therefore, it's a question of only transferring risk. It will, therefore, we should not overstate its usefulness. Credit enhancement will not make a per se unbankable project bankable. So that is the thing. But yes, it's a very important tool, and I think ADB is using it. We propose to do a lot more. We have right now a deal in the pipeline which probably will be about 1.5 billion or $1 billion. And we cannot keep $1 billion on our balance sheet. And it works both ways. We sell credit enhancement. We also buy credit enhancement when we do something which is bigger than what we would keep. Both ways, it leverages our own capital.
True, but credit enhancements help with what I just said, right? This mission of amplifying the multiplier effect of resources that the institution has, right?
That's right.
Right. So let me pause here and ask the audience if you have any question to the panel.
Many of our readers are private investors, retail investors. So if a retail investor citizen wants to invest in those type of projects to mobilize capital in the region, what kind of products should he or she buy?
Not a product that we have recently been using, but all the same, project bonds definitely is one of those. The only complexity, I think, in terms of the private investors, if you want, the multiplicity of these bondholders could become, a bit onerous in administrative and generally in coordination terms, should there be any future issues with the project. So only the more sophisticated private investors I would recommend enter into such a product, because honestly, when there is a case of default, potential default, and the need to sit around the table and restructure, if the project bondholders want to have a say, they clearly need to understand the underlying mechanism very, very well.
And so let me go back here to Topi about collaboration between different actors to mobilize resources to the region. The fact of the matter is that this region is a resources exporting region, right? The thing here is not a lack of resources in Asia and the Pacific, but how to retain them here, mobilize them for the purposes that we want to use them here in Asia. So what's the potential of collaboration for this purpose, Topi?
There is a lot of potential. I think it's underutilized, the potential of the Bern Union members. If our global penetration is 14%, in Asia it's only 7%. So there's clearly room to do a lot more. I've been trying to think, what is the reason for this low penetration? And when I think back the history of my own agency over the past 20 years. 20 years ago, our largest market was China, and mainly public or semi-public obligors. After that, I already told for a while it was the Philippines, and now the largest markets for us are India and Indonesia. Mainly private companies again. I think one explanation is that many of the markets here, as they emerged into net lenders themselves, have very efficient financial systems. And the market gap really concerns the small companies, the small buyers and the small investors. But still, I think, especially projects where the governments are closely involved as an off-taker, for instance, I think, let's say ECAs, private banks, and the multilateral development banks working together can improve the structure of the transaction to be more bankable. But there's no simple answer to this. I think every transaction, every case has its own merits, but I think we should work harder to try and close deals together.
Let me follow up on this question now to Mikael, right? You said 6% of your business is in even less than what I was saying, 5%. Why such a low percentage in a region that represents broadly half of a world economy, right? Measured, say, in PPP terms in GDP. Why such a low percentage? And let me connect this with a question that is being asked here about the financial instruments, product structures that IFIs and or ECAs can develop to tap resources and mobilize resources in the region as we're talking.
Okay, thank you for that. It has different levels to it. On the low penetration rate, I would say that to be fair, it really differs enormously from one country to another. We have some countries where our penetration rate is extremely high, such as Vietnam and Indonesia, for instance, where we also are very involved in a range of different industries, and others, such as China, for instance, where we have had a very, very low penetration rate and very, very modest results. And at times, as in the case of China, the issues could be very much correlated to regulatory requirements and the inability to enter into, say, medium long-term transactions because there are no permits from the local authorities when we have to separate between the short-term and the medium-long-term, which the later is the one where we're focusing on. Other countries have issues where the local banks, which we always seek as partners, are absolutely restricted, if not forbidden, to participate due to the convertibility of hard currency, or rather the shortage of hard currency. One such case is actually Indonesia, where we see this issue, and it is a restricting, if you want, factor to further growth and penetration. But if I go back to the issue of enabling, if you want, or enhancing trade and ensuring that growth is accelerated and there are more players in the market to fill in the financing gap, we are seeing, new tendencies of, filling in this gap, which gives me a lot of hope and, definitely a level of optimism, especially at the banking sector level, but also in terms of collaboration with IFIs and DFIs. If we look at banks, it always is the case that we seek local partners. So there's clearly the international banks that we need as partners, but we see local banks now in some emerging markets that were not there before. Thinking specifically in China, where also they entered into the top 10 names in terms of classification, and that was not the case very few years ago. Australian banks too, and this has to an extent led to increased competition, so it's good for growth, it's good for the region. However, this competition is also driving away some of the international banks. So I think we're going to see many changes there. In terms of filling in the gap between private sector and DFIs and ECAs, I think there's still a lot to be done. However, we're seeing more and more collaboration in terms of co-financing on multi-source projects. That actually has become today the norm. It's very normal to see that level of collaboration. What is still not very normal is to see instead collaboration on certain types of projects. I'm looking at the PPP market, for instance. I'm also looking at industries that are not always, supported by large multilaterals. We know as a fact that companies or IFIs are normally involved in large infrastructure projects. But there is, and renewable projects is another given. But there are many sectors today that require, further collaboration. And I'm thinking of some sectors where, if not for the export credit agencies, many projects simply wouldn't happen. The more difficult environments or projects such as in the shipping, some projects in oil and gas, some projects in steel sector, where you need long-term tenors. And this is where I see this gap, starting to be filled in.
Thank you, Mika. So some of the things that you said about these constraints for mobilizing resources and why this low penetration connect to the question we parked a moment ago, Benji. And so I go back to the same question, connecting with what Mika just said. What are the constraints, the risks, the limitations that you see from the private sector perspective for mobilizing resources in Asia? and particularly in your business for a specific purpose like the one that you formulated a moment ago?
So I think a couple of points to make. The first is that while in the short term we talk about worries about trade wars, protectionism, you mentioned that a while ago, just to go back to that question. I think we've been in the Philippines for 90 years, in the Philippines, and globally more than 100 years. So we look at the trends longer term. And therefore, while there will be in-year tensions or constraints, it does not change our medium to long-term view of the country and the investability in the country. And therefore, that continues to be a key motivation for us to continue to invest and provide credit and support and funding where it's needed. I think that's the first point to make. Now, the second point is that what constraints do we see? It's the accessibility of these funding to the majority of the population. And that is where this water purifier business I was sharing a while ago, it has a 99% payment rate. But we could sell 5-10 times more, have the MFIs have more, microfinance have more funding. But accessibility to funds is not easy when you don't have collateral and the normal insurance, credit insurance, and the normal things. It's very difficult to get these funding for a business that has a 99% payment rate. That's proven. So this accessibility down to the poorest of the poor, the masses, that can really build business and support for private companies like us is what is constraining even bigger growth. And I think that's where, again, collaboration with private sectors and credit institutions and banking and government, non-government institutions should have more of that. So that can be made more accessible. And actually, I think with the trends, fintech would provide a space there where it can potentially democratize funding for the majority of the population.
Thank you very much, Benji. I forgot to say that time is precious in all of these meetings, right? Forgot to say that we were going to close a little bit earlier because of previous commitments of the panelists here. And so I'm going to give the last word to VP Gupta to perhaps summarize the perspective from the bank point of view, where the untapped sources, and talk about a little bit on the plans of the bank to enhance the mobilization of resources going forward.
Well, so as we have just discussed, flows of capital are directly related to the perception of risk. We ultimately put in money where it is comfortable. And that's what we are in the process of doing. That's what the panelists also are in the business of. How do you package credit risk in such a way that it becomes more acceptable to the people who have the money to do it? So credit enhancement, parallel lending, A loans, B loans, all are instruments to do that. But I do want to touch on one other aspect, and that is to say that at least in the developing world, there is a huge amount of capital which is saved as household savings, but it never gets into the banking system. So there is a liquidity issue there, and those amounts are sizable. So if you look at the populations of emerging Asia, the larger countries especially, less than half of the population has a bank account. India had about 42% of deposit accounts. Formal credit was to 20% or less of the people. On an average, as a headcount population, 11 or 12% of the people tap banks for. So how do you change that? So one of the major objectives of, I would say even ADB, would be to influence how this can be done. How can domestic household savings be brought out into productive use for capital and industry? And I think there are 2 or 3 broad rubrics that we need to. One is obviously about, if you have somebody living in a rural area and he has got a branch which is 50 miles away, there is no way he is going to lose a day's wages to be going to a bank to deposit, to withdraw and all. Therefore, people keep money at home. Therefore, getting the banking habit to the doorstep is important. Now, that has also to be done at a fraction of the current costs, because in most clusters of population, a brick and mortar branch is not feasible. And I think digital banking has a very, very strong role to play over there. Today, you have technologies which can leapfrog the entire platform with the merger of biometric authentication, the mobile platform, and a no-frills account. And that is happening already. That is a very important thing. The other important thing is for us to provide the platform. So that is a governmental thing. How do you evolve the regulations, the capital markets, the bond markets, the stock exchanges of countries so that it's easier for small pools of capital to come out at the retail level? I think those are the most important two things that multilateral institutions like us have a role to play in. And the third, of course, is at the large level, project bonds. So that's already been touched upon in a question earlier. How do retail investors invest? It's the same answer as how do larger investors invest. It's a question of providing a platform and providing the enhancement so that people are comfortable. They are comfortable with a stable macroeconomic situation so that they don't have a problem that 10 years down the line exchange rates will go through the roof. And I think that's really about creating the platform. Creating a platform and digital banking.
Thank you very much. Well, time flies when we enjoy what we're doing, or listening, or participating in, and this is the case here. Time is up. Everyone has to move on to the next meeting, so I want to thank very much the panelists and thank all of you for listening, for participating. The conversation will continue, and I would like to ask you please to join me to congratulate the panel with